The Australian interest rate is again on hold. In a bold move, the Reserve Bank of Australia has paused its cycle of interest rate hikes, keeping the cash rate at 4.1%. The pause marks the second time this year, following the one in April, that the bank has decided to hold off on rate increases within the cycle that has extended over the past year or so. Some economists believe that this pause was an inevitable move. They cite reasons such as the notable downturn in inflation following a sharp rebound in April. It fell dramatically from 6.8% to 5.6% in May. The peak of inflation has passed, indicating a period of economic stability in Australia. However, not everyone agrees. Many hold a contrary view, predicting that the current cycle of rate hikes is still ongoing. They argue that we should expect at least one or two more increases, suggesting that the high interest rates will last longer, potentially driving the Australian economy towards a downturn. In this episode, we will dive into the data to analyze the current state of the Australian economy and its potential future trajectory. Will the Reserve Bank of Australia raise rates again? Recently released data for June adds another layer to the story. Australian house prices continue to surge, but there are signs that the upward momentum may be flattering. In the latter part of this video, we will dive deep on these signs and what they may imply for the future. Lastly, for those currently experiencing mortgage repayment pressures, we will provide 7 useful suggestions. Stay tuned to discover what this might be. Hi there, my name is Alex. Welcome to my channel, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. Before the RBA's decision to pause the interest rate hike, I predicted the same. In June, the decision on whether to raise the interest rate was already on a knife edge. Just days before the hike, the federal government passed a proposal to increase the minimum wage by almost 5%. This move added unexpected pressure on inflation, as higher incomes naturally lead to increased consumption, and subsequently a rise in inflation. Then the RBA went ahead with another hike in June. However, before the June hike, there was no additional wage increases. The inflation had already dropped from 6.8% in April to 5.6% in May. Taking into consideration the slowdown in inflation in the US, dropping from 4.9% to 4% within a month, which was very close to the Federal Reserve's target inflation rate of 2 to 3%, it was likely that there would be less rate hikes or even put on hold in the next meeting. All these positive factors indicated the Australian Central Bank's possible decision to pause the interest rate hike, and as it turned out, the final decision was in line with my forecast. I read the Reserve Bank of Australia's statement on the pause in the July rate hike and came across several interesting points. Each of these points could potentially impact the future of our economy. Firstly, the pause in the rate hike does not necessarily mean the end of Australia's interest rate hike cycle. The central bank believes there are many uncertainties facing the Australian economy, and this pause allows the bank more time to assess the state of the economy and the impact of previous successive rate hikes before making the next move. Although Australia's inflation peaked and started to decline in May, the rate remains relatively high and might maintain this level for some time. High inflation, low wage increase will inevitably lead to a decrease in the standard of living and slow economic growth. For instance, people may decide to delay purchases, cancel planned trips, and compare electricity and phone service providers just to find the cheapest options. As consumers tighten their belts, businesses may have to put previous investment and expansion plans on hold. The wealth gap may widen as inflation disproportionately affects the lower and middle income groups, while the rich control numerous channels for wealth preservation and growth. The central bank's report also mentioned that the future rate hikes are possible, but this would be subject to the economic performance and inflation. The next inflation data is due to be released on the 27th of July. If the RBA does not like the inflation data, there is still a possibility of a rate hike in August. When researching, I noticed an easily overlooked point. Why is there still uncertainty about future inflation? Isn't it clear that inflation is already decreasing? Well, inflation in May did drop from 6.8% to 5.6%, but different indicators are used to measure inflation, and a closer look reveals more detail. Inflation involves various factors, such as rent, which increased by 8.4%, while fuel prices decreased by 8%. We take out items with the most price volatility such as fruits, vegetables, and fuel. The core inflation only dropped from 6.5% in April to 6.4% in May, essentially remaining unchanged. This led several analysts to point out that the central bank's decision to pause the interest rate hike was like gambling with the market. They stopped the rate hikes under the presumption that the next inflation data will show improved figures, despite the fact that inflation remained virtually unchanged for now. In my view, the central bank has already done what it should to mitigate the difficulties faced by the public, giving the market a chance to breathe. This decision has provided us with a month's window to adjust our spending habits and make necessary financial arrangements. This is particularly important for those already caught in the debt trap and those facing financial difficulties. However, for property investors, this is a bearish indicator in the short term, but a bullish one in the long term. New data shows the Australian property market had another price increase in June. House prices across Australia rose by an average of 1.1%. Sydney again led the surge with a 1.7% increase, followed by Brisbane at 1.3%, Perth at 0.9%, and Melbourne at 0.7%. Despite continuous interest rate hikes in Australia, people's confidence in buying properties seems unchanged. The price growth in Australia's 4 major cities slightly declined in June. The increase in Sydney dropped from 1.8% in May to 1.7% in June, Melbourne from 0.9% to 0.7%, Brisbane from 1.4% to 1.3%, and Perth from 1.3% to 0.9%. The momentum of the upward trend in the property market is weakening. On the other hand, the auction clearance rate has dropped to 71.2% in Sydney, and the same trend appears in other major cities as well. The pressure of home loan repayments is rising due to the multiple interest rate hikes, and people can genuinely feel it. The slide in auction clearance rate did not start to happen last week. It started at the beginning of June. If interest rates increase too much in the future or more frequently, the clearance rate may further decline, and property prices might stabilize in the short term. After all, only part of the repayment pressure can be offset by the high demand and high rent in the rental market. We've also noticed the slowdown in the speed of rent increases across Australia, and the number of properties for sale on the market is likely to increase gradually. Starting over a year ago, when interest rates began to rise, people initially didn't pay much attention. Many bought houses during the pandemic when the interest rate was at their lowest and locked in for 2 years. However, over time, with 12 consecutive interest rate hikes, more and more people have realized that their fixed interest loans will soon expire, and the rate will go from around 2% to the current rate of around 6%. The amount of interest repaid will triple. Across Australia, about 1.4 million people are under significant repayment pressure. Every expense in a household is on the rise: rent, utilities, groceries, daily necessities, and mortgage repayments. But wages aren't keeping up, so the pressure is still there. A report by the RBA shows that the lowest income Australians who have mortgages spend at least 1/3 of their income on mortgage repayments. It was the research result at the beginning of this year. And with the rising interest rate and living cost, the same group of people is likely spending about half of their income on housing now. This information gives a clue about what kind of properties you should buy. If you can figure it out, you're on your way to understanding the Australian property market. Low-income earners are susceptible to house prices, so much so that a difference of 5,000 Australian dollars can determine whether they buy a house. Those people typically live in mature and low-priced areas far from the city centre. These areas lack planning and future development, face competition from the nearby developing suburbs, and have limited potential for price growth. Thus, one of the most important strategies I use is to buy in developing suburbs rather than mature low-end ones for the same price. So are there any ways to relieve the pressure on home loan repayments? Yes, there are. First of all, ask your mortgage broker or bank manager if you are overpaying fees because you have offset and redraw accounts. If you have both accounts and the bank charges fees for providing them, you may be overpaying up to $1,500 a month on a $1 million loan. Number 2, look for opportunities to refinance with another bank or financial institution. But remember, you should aim for an institution that offers a lower interest rate and easier stress test. 3, if you want to avoid the hassle of refinancing, call your bank manager or mortgage broker to see if they can offer a better interest rate. Almost all banks are currently offering discounts on their loan products. The discount rate depends on the bank, credit history, and the loan amount. 4. Change your lifestyle and spending habits. Many people facing rising loan interest and cost of living crisis still maintain their old lifestyle, spending money on alcohol, travel, and handbags as they used to. Managing your personal life is much like running a business. When faced with a crisis, you should cut costs where necessary. 5. Extend the loan period to reduce monthly repayments. But be aware that extending the loan period means paying more interest over the repayment period. For example, extending a 25 years loan to 30 years would reduce monthly repayments, but the total interest payable on a $1.3 million loan would increase by $270,000. Number 6, see if you can switch to interest-only loans. Like the previous method, this is only a temporary solution. Monthly repayments will be less because you are not paying the principal. The interest rate will be higher, resulting in more actual interest repayments over the lifetime of your mortgage. 7. Look for financial institutions that are still offering cash back. Although there aren't many on the market right now, you can still find them with some effort. With that being said, please follow me on social media at RealCoachAlex. Smash the subscribe button and turn on the notification bell to receive new weekly videos. Hope to see you soon. Have a good one.